Hello, I'm Mike Graham, the president of Midwestern Securities and the host of the Banking on Growth podcast. With us today for this episode is Chris Lockhart and Jason Beiswenger from Wipfli. Welcome, gentlemen. Thank you for being with us today.
Thanks for having us, Michael. Appreciate it.
Yeah, thanks, Mike. I look forward to being here.
Excellent. I look forward to our discussion, wherever it goes, but targeting OBBB, the one big beautiful bill. But before we get into that, will you guys give us a little bit of background on Wipfli and the type of work that Wipfli does for your clients?
Absolutely. I'll take that to start. Just give a little bit of introduction to myself and Wipfli, the accounting firm, and I'll turn it over to Jason to add anything that I miss there. So, Wipfli is a top 25 accounting firm. We have 52 offices across the U.S., might be 53 by the time this gets to publication, but 3,200 associates, and we're serving about 55,000 clients. I'll say this, we go to market by industry. Some of our larger industries is manufacturing, retail, distribution, construction, real estate, healthcare, and of course, financial services, community banks, and things like that. Chris Lockhart, I head up the private client group. So I come in from a little bit different space. I'm the B2C component of Wipfli. So we work with families, trusts, foundations. We're really working with Mr. and Mrs. Smith. And my group is about 100, 110 folks across the U.S. and we're serving about 19,000 clients. So a pretty good group there. And with me on the call today is Jason, who is I'll let you do your intro.
Yeah, sure. Thanks, Chris. Yeah, Jason Beiswenger here, partner at Wipfli as well. Chris's counterpart, so to speak, in the Northeast region of the U.S. So CPA here, been practicing for 15 years myself and lead the firm's private client group for our Northeast region.
Awesome, guys. Well, you guys are the experts in all things tax and one big beautiful bill. So let's jump into it. Will you give our audience just kind of an intro or an overview of one big beautiful bill?
Yeah, sure. So big picture, one big beautiful bill. I'm going to refer to it as OB3, which we've dubbed it here at the firm. I think some other practitioners have as well. Rolls off the tongue a little bit better. So OB3. 870-page bill that covers much more than just taxes. Actually covers a lot of sectors of our economy. So there's a lot of interest in this bill leading up to it. I know a lot of folks are following it. And I know today we're going to focus on more of the tax revisions in there, but the bill itself is a huge bill. There's so much in it that affects, again, nearly all kind of facets of our economy here in the US. So at a very high level on the tax side, OB3 extended many of the provisions in the Tax Cuts and Jobs Act, which was the last recent round of tax cuts that were passed in President Trump's first term. And there were major updates to some of the rules, and it was kind of building along the Tax Cuts and Jobs Act. And it also added some new benefits for, as Chris referred to, Mr. and Mrs. Smith and everyday taxpayers. So tax brackets at a high level have been locked in at lower rates what they were under the last time that the TCJA was passed. And, it allows for some predictability now and a little bit more certainty in tax rates and what they're going to do on a go-forward basis, which the last couple of years, a lot of us practitioners we're really curious as what's going to happen because a lot of the provisions in the Tax Cuts and Jobs Act were set to expire at the end of this year. So without OB3, we were left with some uncertainty around a lot of the provisions in TCJA.
I'll just add on a couple of other things on that. I think about this from a couple of different perspectives, and we're going to get into some of the benefits that this bill is giving folks, both retirees, those that are making kind of middle income, and even those that are high net worth or ultra high net worth. We'll talk about some of the specific things that came out of that bill, that opportunities that you could take advantage of. But I'll double down on what Jason was just saying about just having consistency and understanding where things are going to be for the next several years. That allows us to really kind of hone in from a tax planning perspective, right? If you think about, I say this a lot, a client calls me and they say, hey, I want to save on taxes last year. There's not a lot that we can do with looking in the rear view mirror, but if we have a clear picture ahead, there's a lot of things that we could put in place and a lot of ways that we can help clients. So I think having that understanding where we're going to be 2 years from now or 3 years from now gives us a lot of clarity and allows us to really put in some things in place. We'll get into, opportunity zone funds a little bit. We'll get into QSBS, qualified small business stock, a little bit. We'll get into tax brackets themselves. We'll get into some of the deductions, the SALT deduction or the new Social Security deduction, some of those things that will impact folks. But having that visibility and knowing, hey, here's where the AGI limits are for this, or here's what I need to do to be able to take advantage of that over the next several years, I think would really allow for us to help folks plan better.
Sure. So predictability, consistency, and the fact that tax rates aren't going up like might have been considered 10 months ago, pre-election, those things can be stimulative potentially for spending and economic expansion. Let's dig into this a little bit more. So what are some specific opportunities or potentially risks of OB3, which I really like that phrasing. It's easier than OBBB or the one big beautiful bill. It does roll off the tongue. So OB3, opportunities and risks.
Yeah. So I think from an opportunity standpoint, like I was saying earlier, there's something in this bill for everyone. Really, you've got to look at it on a case by case client based with, as an individual, as a business owner, as a retiree. There's so many groups that this bill impacts. And I think at our firm, how we've approached it early on is we're just having a lot of conversations with all of our clients and with folks like yourself to really educate, the general public and our clients on what opportunities are in here. And really depends on, what kind of hat you're wearing, what lens you're looking at it from for what the opportunities are. I mean, for example, I'll put it in a few different buckets here. So if you're a small business owner, for instance, this bill greatly improved upon the ability for a business owner to take immediate deductions for their capital assets. So, what we refer to as bonus depreciation before. So say someone buys a capital asset or a piece of equipment. Before this bill was passed in 2025, you can only deduct 40% of that immediately. With the passing of OB3, it's now at 100% for that piece of equipment. So you can write it all off in year one. So things like that can have substantial impact and decision, for decision makers in a business, and especially, as you think about stimulating the economy and what you're going to get in return in tax savings for doing an investment like that in a piece of equipment. And then similarly for a business owner, what was in the Tax Cuts and Jobs Act, what we refer to as the 20% qualified business income deduction. So basically, if you have a business and you're pass-through business structure type, you're able to take a 20% deduction on your income. And that was something that was going to be slated to expire at the end of 2025 without, the passing of OB3. So, that deduction is a really substantial one for business owners that's now been extended. So that's kind of a business owner cap. You've got ability to deduct equipment on a quicker basis, and you've also now, have a deduction for and 20% continued for, your qualified business income. And then some other business owners as well are going to, especially in the tech and innovation sector, a big headliner on here was the ability to immediately expense research and development expenses. So in the past couple of years, anyone who's incurred R&D expenses, you've had to write those off or over either 5 years or 10 years. Now, this bill brings back the ability to deduct all of those expenses in year one when you're incurring them. And there's also some provisions depending on the size of your business that if you've got some expenses that were tied up the past couple of years that you haven't been able to write off because of the prior tax laws, you might be able to work with your CPA and write those expenses off immediately, which is great news. So there's a lot of things in here that will affect business owners. Those are kind of the headliners for opportunities. And then if you're someone who's, a middle-class taxpayer earner, some of the headlines that I think are probably of interest for you are, specifically related to no tax on tips was what the headline was. And There's the ability for you to be able to deduct up to $25,000 per year of your tip income, depending on your income cap. And then also the same for overtime pay as well. You've got an ability to deduct about $12,500 annually on any overtime pay that you have. So, for our middle class earners, there's some provisions for them as well. And then for retirees, there's a new Social Security deduction as well that, if you're someone who's over 65 and have adjusted gross income lower than 150,000, you now have the ability to take up to a $6,000 deduction if you're single, or 12,000 if you're married, against your income to lessen your tax burden overall. And then one last one here, but definitely important, and not a lot of headlines here related to what Chris referred to as the salt deduction. Not table salt, but salt. Here in the tax store, we say state and local tax is what SALT stands for. So prior to the passage of OB3, you were limited to only $10,000 of state tax deduction on your return. That threshold has increased to $40,000 for someone who makes less than $500,000 a year. So those are just some of the headlines by bucket. I mean, we'll get into some of them a little bit detail, but opportunities, there's a lot of new provisions in here, and it's not all just extensions of the Tax Cuts and Jobs Act.
Yeah, I think I'll add a couple of things, Jason, going back to the first, you were talking about business owners. You're also talking about the R&D credit expense. And I was on a call just the other day with one of my clients, and one of the things that we're looking at is, there's quite a bit of amortized expense from the last couple of years that are sitting there. Now you have the option that you could take that this year, or you could do it this year and next year. So the conversations around, well, how do we generate income to take these expenses against? Do we delay bonuses, or do we look at something from a compensation perspective there? So, it's that ability to look ahead and help plan with folks on these things that becomes really important. Going on to the middle class, and I know, Michael, you guys work with a lot of financial advisors out there and financial planners, and I think what really becomes important for all of us that help clients to understand is, what are these opportunities and what do I need to be thinking about and helping my client know for the future? So, for instance, if we're working with a retiree, somebody that's earning Social Security, and we're looking at maybe doing Roth conversions or Roth, IRA planning with them, or maybe there's some trailing executive comp, stock options, or other things. We're looking at timing of stuff. Well, now we can look at that AGI limitation for that deduction, 150,000. We can map out and plan, and that's not just the accountant doing that. I think that's kind of lockstep with the financial advisors sitting at the table together. Like, let's look at what's happening for the next 5 years and maximize. Talking about the SALT deduction, Jason, you talked about the 500,000 threshold there. And, I know a lot of folks, either you're in a high tax state, your income tax gets there, or maybe you have a couple of properties and your real estate tax is going over 10,000. I think for a lot of clients, they weren't able to take advantage of all of the state tax deduction that they were paying. Now we can look at this and say, hey, how do we make sure that we're staying under that AGI limitation and enhancing or maximizing that credit? And again, I think about all those levers that we pull from an income perspective and from a deduction perspective to make sure that happens. So I think as we look at all these little pieces and making sure that we're kind of coordinating and looking at that over the next couple of years, at the end of the day, what I tell clients is there's no magic bullet, right? The days are gone where you take your money and hide it in Swiss accounts. I mean, that was decades ago. But what the government does give you is all these little ways to save on tax. And if you build it up and you do it all, you eventually make mountains out of molehills, right? So if you're consistently being tax efficient, you can end up saving a lot on tax just by doing the little things. So
this is really good, guys. It seems to be very stimulative. It seems to be there's opportunities for almost everyone in here to benefit, keep more of their hard-earned money, send less of it to DC for somebody else to spend it for us. One thing that you mentioned was Roth conversions. Let's talk a little bit about Roth conversions. By the time Main Street starts talking about Roth conversions, it was, there's a lag. By by the time it gets to grandma and grandpa calling and saying, hey, I've got $1 million in my IRA. And some, TV show I was watching or some magazine I read said a Roth conversion is right for me. Now, with tax rates not going up like they were anticipated to, probably when that article was written or when that article was thought about being written, are Roth conversions as attractive today with tax rates not increasing like they would have if Trump didn't win the election?
That's a great question. I look at it from a couple of different lenses. And the first thing I would say is filling up your tax bracket, right? So I often work with financial planner, financial advisor to understand, hey, where is the client going to be 5 years from now, 10 years from now, especially when we're in RMD age? What does that IRA look like? What tax rate are we going to be looking at 10 years down the road? And I think about, okay, if we're at 22% taxes today because the client's retired and there's no wages coming in, Social Security maybe is there, maybe isn't, but we're at a low tax bracket. But we know once that RMD happens, we're going to be back into the 35% bracket. Well, I think it's a no-brainer to fill up the 22% at that point. I think it might even be a no-brainer to fill up the 24% at that point. I don't want to pay 35% today when I'm going to pay 35%, likely in 10 years. But if I can get a decent delta on that, absolutely, I think that makes a lot of sense. Go ahead and bring in some of that, reduce that future RMD, get it into a Roth. I think in each advisor has everybody has a little bit different opinion. You can model out things quite a bit, different ways and different assumptions. I think for what I look at, long gone is that absolutely everybody must do a Roth IRA, all of it today. Now that we have the need to distribute out after death and you can't just carry it forward for all of your children's lives, that math doesn't work as well anymore. It used to be you could say absolutely convert at 37% because your children are going to benefit from it 60 years from now. Now that you have to distribute out the 10-year rule, I don't think that's the case anymore. But I think in a lot of situations, looking at the tax brackets, filling up what you're at right now makes a lot of sense. And I do that with a lot of clients. I don't know, Jason, do you have any other thoughts on that?
No, I think like you said, Chris, it's really modeling it out and taking advantage of those brackets and, really have a true understanding of what your situation, a little bit of forward thinking on what your income might be is definitely important to be able to take advantage and make smart decisions about the Roth conversions.
Sure. A lot of clients do ask that question, and a lot of them think that there's a formula that always plays out. And I tell them it's as much art as it is science. We don't know how long you're going to live. We don't know what future administrations are going to do with the tax rates, but that's good. That's really good flavor and thoughts, guys. I appreciate that. So let's go the opposite. Let's go kind of macro on this topic. A lot of people are saying, hey, the tariffs are going to create large inflation inside of the U.S. and there's fear around tariffs up to Liberation Day. The S&P 500 was negative about 14% for Q1 over the fear of how tariffs will negatively impact the U.S. and global economies. But there's a couple other things that are offsetting tariffs potentially. One is taxes. Taxes aren't going up, so the markets come back significantly since Liberation Day, April 2nd. The stock market's having a very strong year to date as of August 14th here. And the second thing that offsets any negative impact, a significant amount of the negative impact year to date, is low oil. If we look at major indices year to date, one of the only negatives is oil. And so keeping energy costs, which energy is a tax on everyone, and keeping real taxes lower has likely offset some of those impacts of tariffs. So we went very, to the client level, and I'm zooming way out to more of the macro level. Do you have a perspective on economic outlook in general in some of these policies?
I'll take that again. And I will first say this. I am not a financial advisor. I'm not a financial planner. I am a lowly accountant. And so I'm going to answer this from a tax perspective. I can't give financial advice, and you wouldn't want me to. I will say that much for sure. I always talk about this. It's a three-legged stool, and I want to be there for the client as that accountant leg, and I want to have the financial planner, financial advisor to be there, and then the estate attorney being that third leg, because I know what I know and I know what I don't know. But I will say this. Anytime that there's a market that has any sort of turbulence, there's absolutely some tax opportunities within that turbulence, right? And so if we look at, hey, and you know this, you own Coca-Cola and it drops in value, and you can lock in a loss and sell that position and maybe buy something in the same sector and buy something that's similar that's going to potentially rise, Pepsi or whatever it is, you lock in that loss and now you have a capital loss carry forward. I look back to 2008, 2009, when we had significant market turbulence, and the smart people were the ones that locked in those losses, generated that capital loss carry forward, and then didn't pay tax on their capital gains for the next several years, right? I think that's, answering from a tax position, that's the opportunity that you get from market turbulence, is the ability to look at your portfolio, take the losses that you can, lock those in, and have that as I think of it as a deferred tax asset. Whether you're going to eventually sell something that's at a gain later on and you can offset it, or here's what I find most often. I have a client that owns a condo in Florida that's their second home. They go to sell it. It's appreciated in value. They don't remember that they're going to pay capital gains on that sale, right? Your first home, your primary home, you have an exclusion of $500,000 if you're married, and you kind of tend to forget that you're going to pay capital gains tax on the rental or on the vacation home. And so you have this deferred tax asset that can help offset it. So while I don't have an answer on the market, I will say turbulence gives you a lot of opportunity to take advantage of some tax planning.
I think that's a really good answer, Chris. And I appreciate the concept of collaboration with the CPA, the CFP, and the attorney, and thinking holistically around these scenarios. I had a joint meeting with an estate planning attorney and a client and his wife yesterday, and his sister and her husband yesterday, doing some of the family planning. And so I totally appreciate that perspective. And we have a saying for long-term investors around some of the volatility that you're talking about, planning around and through, that volatility is a gift for those long-term investors. It's a gift to do some tax loss harvesting. It's a gift to accumulate some assets on sale potentially. But anyways, thank you for entertaining my questions a little bit off OB3. But let's come back to OB3. Are there any risks that we need to be aware of around OB3?
Yeah, I think, when I think about risks in OB3, it's I think it's just the sheer size of the bill and the way that OB3 was passed, again, very similar to TCJA, and it was done through the budget reconciliation process. So, the nature of that is that you've got to look at a 10-year budget window ahead and evaluate the fiscal impact of the bill. So in order to, balance the budget, so to speak, what they had to do near the end as they were reconciling this was some of the provisions in here are sunsetting early, some are permanent, some are retroactive going backwards. So there's all sorts of dates scattered within OB3 of, when certain provisions become effective, when they're not going to be around anymore. Or maybe in some cases, like I said earlier, they're just permanent altogether. So there's definitely some traps in there with the tax planning. So you definitely work with your advisor, look at these things closely before you're making big decisions as a result of OB3.
Yeah, I was just going to add in, we're going to talk about a few things a little bit later, but I will say this. We're going to talk about estate planning in just a little bit. if you look historically at estate tax law, it's probably one of the biggest political tax footballs there is. And we've seen 13 or 14 major changes in like the last 30 or 35 years. So I would say, there's probably, I don't want to say risk, but this too shall change, is probably what I would say, to some of this. The other thing I think that, Jason talked a little bit about this, there are some things that are sunsetting, and I think he's going to talk about energy credits in a minute. And so understanding what opportunities you might need to take advantage of this year versus, you can do this next year or the year after. Vice versa, there's some things that you're going to be able to take advantage of not until next year or the year after. So just being cognizant of kind of the dates and times. Final thing I'll say, while Jason has read all 840 pages of this, I have not. And so I think we're all going to learn more. There's a lot of spots here where, the IRS needs to come out with more information for everybody. So there's going to be more to learn, as we kind of go throughout the year.
Okay. So before we get into estate planning, that's a good teaser. We'll come back to that. Is there anything we want to wrap up on that itemizers need to be aware of? We touched on a little bit around salt in some of those items, but is there anything itemizers or folks taking the standard deduction should be aware of?
Yeah, I think really the only thing we haven't touched on, like from an itemizer standpoint, is really the charitable deduction. And this is one that is it is not a taxpayer friendly provision in OB3. So starting in 2026, there's actually going to be a new floor for anyone who itemizes and claims the charitable deduction. So you're basically looking at a 0.5% floor based on your adjusted gross income that is going to reduce your overall what you're able to claim for itemizing the charitable deduction. So that's something new that we've got out for charitable specific. And then overall, if you're a high earner, so someone over $500,000 of income, you might be subject to an overall limitation on your itemized deductions as well. So going back to doing some planning and what can I do maybe in 2025 here to accelerate some of my itemized deductions? Can I utilize a donor advised fund to take advantage of a larger deduction, but then be able to spread that money out in terms of getting it in the charity's hands over a number of years to be able to avoid the last year here, last few months before that floor kicks in or that overall itemized kicks in. So yeah, there's a couple changes on the itemized side, and there's some things to do here, in the next few months that you can do to potentially take advantage before some of these limitations take effect. And then on the standard deduction side, overall, the last few years, we've been used to a higher standard deduction. In 2025, it's going to be $30,000 is what that standard deduction looks like for someone who's filing jointly. So that's now permanent in OB3. And then coupled with the standard deduction, and we saw this actually back when it was a couple of years during COVID, there was a temporary provision in the revenue code that basically allowed you to, if you're taking the standard deduction, in addition to that, you can also take a charitable deduction as well to, again, stimulate charities, but, encourage them to, get money in their hands. And that's now back in OB3. So that's starting in 2026. So you can now take standard deduction plus either up to $1,000 if you're single or $2,000 for charitable donations as well. So, while I never tell people the tax scale should wag the dog in terms of making charitable donations, but if that plays a significance in your calculus as you're looking to make donations here for the rest of the year, those are some things to think about in terms of timing that may impact the tax benefit.
I think the only thing I'll add is even if you don't itemize, grab those receipts when you go to Goodwill or you make the donation to the zoo or whatever it is that you're donating to. Even if you don't itemize, having that receipt, there could be a potential benefit, like Jason was saying. And then just to reiterate, and Michael, I'm sure you've talked about this before as well, but the bunching strategy around charitable and using donor advised funds. I mean, that's just going to become even more important. It's been something we've been talking about to clients for the last 6 or 8 years now, but it just adds even more importance to it from both the floor perspective and also from that new limitation that's going to come in. So
Good. Those are really practical things to be aware of. Thank you, guys. So let's transition to estate tax planning. What are you seeing? What questions, fears are you seeing out there that people need to be planning around for the preservation or transfer or taxation of estates?
Yeah, I mean, I think the general feeling when this was passed was, I think, a lot of people relief, followed by, finally some clarity here, at least, for the foreseeable future here for at least this administration, until the next iteration of tax cuts or tax changes happen. But at least for now, like, we got a little bit of clarity and, surrounding what the estate exemption looks like, because you can't undercut. There was a lot of planning and, a lot of discussions were had, at least, amongst Chris and I, ourselves, their advisors. If you had an estate that was going to be in that taxable realm, say even, if you're worth at least even just $5 million, there was someone that, there was some planning that could have been done. We were talking about doing, creating different types of trusts and things like that. And we weren't quite sure how all this was going to lay. But I think now that we're back into, an extension of really the higher rates, some of the highest rates that we've ever seen for estate exemptions, that being 13.99 million, we've got a little bit of clarity now going forward. And, it's increasing it going forward. And, while it hasn't changed the highest marginal tax rate being 40%, if you're over that amount, at least now for a lot of people under, they're breathing kind of a sigh of relief here, of what it could have been, had this not been passed.
I think just a couple of things to add real quick there. It definitely has given some clarity. When we look holistically at this, I think the number is somewhere north of 70 trillion. It's a large number that is going to be passing from one generation to the next over the next 20 years, right? We're looking at a significant wealth transfer from family members to the next generation. And so even if we're not in a taxable estate, right, even if it's the less than 30 million, we're still getting a lot of questions from clients. I'm seeing a lot more gifting than I did, say, 10 years ago. So this is something absolutely on our clients' minds. And as they're looking at, hey, my kids are now older, I can trust them now, or how should I effectively give to them? What should I be thinking about? What should I be doing? Those conversations are happening. And then on the other side, for those that are in taxable estates, we see the rise of slats and grats and some of these more interesting trust structures that allow for you to be very tax efficient in your transfer of wealth. And so we're having a lot of conversations with clients around these matters right now.
It's interesting. It's one of the gifting, for example, is one of the least understood aspects of tax law. I think something that clients who want to talk about have heard something, pull on some thread, but really don't understand how it works. Whether it's just annual gifting to their kids and in-laws, or whatnot. But I was talking with those clients yesterday at the family meeting with their attorney, and mom and dad had an estate of these particular clients of about $2 million. And they had a marital trust. And I said, well, why do they have this? Well, they wrote this in the late 90s when the gift tax exemption was $600,000. That's why they wrote it. It's been a moving target. But so we write these things, and we need to review them from time to time and modify them as the tax laws change, et cetera. But very interesting. What do you see are the biggest barriers to getting clients to act on recommendations?
Yeah, I'll start off on this one, Jason. The first question is always, am I going to have enough? Right? I worry about my own well-being. I worry that I have sufficient funds to do whatever I want to do with my life. And then, of course, the next question is, are my kids going to, use it well? And then I'll say this. I actually had a client one point. I did this fantastic. I worked up this plan. Took me 2 weeks. It's a fantastic plan. I was going to save we were doing an NUA election and a Roth conversion and all of these things we're going to do. And we're going to transfer essentially a significant sum to this gentleman's heirs when he passed away. And it just was this beautiful plan. And the gentleman took one look at it and he said, I don't want my kids to have that much. So you kind of have this full range of different things that come into play. Each family is just a little bit different. And the fears and the worries and the concerns. Now there's different things that you can do, right? With the slats, or other trust instruments to help alleviate some of those fears. But it all comes down to that and the fear. What I usually say to a client is there's some gimmies, right? There's some things that are just absolutely make sense and should be done. And for example, we were talking about Roth IRAs earlier. If you have a child, if you have somebody that's in college, that's working a job and is starting to earn wages, gift enough to that child so that they can make their Roth IRA contribution for the year, right? Like that's a gimme. It's now going to be in a tax-free account for the rest of their lives. I mean, that's about the best use of $7,000 that you can ever have. And so when you start putting some things like that in front of a client, just some very easy to understand, why would I do this? What's the benefit? Oh, you're telling me it's a gimme, it's a no-brainer, right? So you can start with some of that. And then you get to some situations where the client might not want to file a gift tax return. I want to go over the exclusion and I want to have to do all of that. Well, just a reminder, you can pay for medical expenses directly or education expenses directly, and those aren't going to be counted. So there's some more kind of just very easy to understand things. Oh, I get that. My grandkids, I can start paying for their schooling or use the 529 plan and make contributions to that. So I think it's kind of baby steps to the door a little bit in some situations. Like, here's some very easy to understand, easy to digest things. And let's start there. And then we can work on those other fears or those other concerns or those other worries and address those with whatever the actual appropriate answer is for that. Does that make sense?
It does. Absolutely.
And I think that they're hard conversations too to have, Michael. I mean, a lot when you're having these discussions, it's not, some of it can be kind of morbid, right? When a client's thinking about, hey, what's I don't want to think about the day that I pass away. And sometimes it might take months to even get a client and their family kind of in the right frame of mind, right? To start to think about some of these things. When you're picking it up and putting it back down. But I think it's, continue the momentum, continue to have the conversations, and eventually they're going to open up and become comfortable with it. And then, once you start to get there and kind of realize what the motivations are, it's really working with the team surrounding that client to get something that really fits, for that client, and not just kind of saying, hey, this is the strategy, this is the one that works, because we all know here it's not a one size fits all. It's the best plan is the one that, the client, walks away and feels happy about and, signs off on.
Yeah. What you're talking about is a very interesting, very advice-driven client engagement and general experience. We all have what we call record collection, what experiences have formatted how we think or how we operate with different businesses. I think that I tend to think of my experience with most of our clients' accountants in more of a transactional manner. They turn in their tax returns. Maybe, they pay their bill. They may call at the end of the year and say, hey, the farm looks like the income's going to be about, is there anything we should do? Should we buy a truck, in December, those sort of transactional moments. And sometimes CPAs that our financial advisors work with will say they're frustrated. They meet with their clients. They tell them they need to open a single K or a SEP or, a 401k, or they need to increase their 401k into a cash balance plan, or so, they give ideas, and then they meet the next year to start to file their taxes. and they're all of a sudden surprised that the client didn't act on anything. And I think sometimes they act in that transactional manner. You guys sound like you have a much more engaged and ongoing relationship with many of your clients. In those transactional clients, though, do you ever experience reaching out to them, 2 months later saying, hey, we mentioned we might want to start doing this and start planning on this rather than waiting until next March? What do you see in your experience?
Yeah, I mean, I think the approach that Chris and I bring working with our clients is, and we bring a team to the table. Even within the firm, we've got various levels of experience and perspectives that we bring to the client engagement, for all of our clients. And I think that allows us to be able to pick it up, put it down, send reminders, because we've got multiple people that are familiar. So, while someone might think of something, one planning idea, then we just bounce ideas off one another. But that allows us to have those more frequent touch points with clients, to be able to keep these things moving and keep the momentum. So, it's, we're not at the point where we're filing taxes in April and saying, oh, hey, did you open up this, defined benefit plan that we talked about? So, yeah, I mean, that's our approach. We found it works really well, Michael, for when for situations like that.
Yeah, I think I'll just add a couple little things. I mean, I certainly have clients that don't want to think about taxes throughout the year, and they want to just talk in April, and that's okay. But honestly, our best clients are those that want to talk frequently throughout the year. That's what really engages us. That's who I look forward to working with, and who our ideal client is somebody that we can be proactive with and connect with their advisors to make sure that we're looking, ahead. I think about it this way. I never want a client to be surprised by the IRS. I never want a client to be surprised by our bill. And I never want the client to feel like they can't get a hold of us. And I think if you do those three things, right, you are serving the client well. And so that's what I focus in on, is responsiveness, helping you to understand what to expect for the next tax year, right? Rather than, oh, what's that bill going to look like? Let's hope you understand what's going to look like. Let's do planning. Let's look forward. And then, again, not be surprised by our bill. So.
Yeah. Our advisors' deliverable is the advice and the relationship navigating the capital markets and financial planning. And it sounds like that's very much in line with how you guys think. Your deliverable is the advice, navigating the different business tax, gifting considerations, etc. There's a lot of value in that. Let's talk about a couple other quick things before we wrap up today. So you mentioned solar and energy tax credits. What would you guys like to cover there?
Yeah, honestly, the most important thing to cover is there's nothing really new in OB3 for solar and energy incentives. Most of it was actually accelerating those deductions or credits going away. From an individual perspective, let's put them in a couple buckets. I guess the first one I'll say is anything related to, kind of a new vehicle purchase. Historically, last few years under the prior Biden administration, we were looking at, credits for electric vehicles or hybrids or plug-ins, whether they were new, whether they were used, whether you use them for the business. There was some sort of credit that was generally going to be available to you for an EV. Now under OB3, those are all going to be terminating in large part at the end of September. So, you've got, as of today, when we're recording this, it's August 14th. You've got till the end of September 30th to purchase your new vehicle and put it in service to be able to take advantage of those credits related to the electric vehicles. So kind of the next bucket I'll look at is in terms of energy credits are, the household ones that we're all familiar with. If you put in a solar system, in your house, or you're putting in solar, water heaters, geothermal heat pumps, battery storage, anything like that related to solar for your house, is that we had a 30% credit for that. That wasn't set to expire until 2034 under the prior rule. Now that one's going to be expired as of the end of the year. So December 31st, you haven't got your your solar panels on your house, then, the credit goes away. And then, kind of a category that a lot of us are familiar with, but the deduction's not so big. So to spend just a second here is, people are used to getting a small credit or benefit for installing energy efficient windows, doors, skylights, air conditioners, things like that. That credit also is going away as of December 31st this year as well. So I think to kind of summarize it all up, if you're buying an electric vehicle, do it before the end of September. If you're doing any sort of energy efficient property improvements, solar on your house, get that done, installed before December 31st of this year.
Yeah, nothing to add on that. Just know those dates.
Yep. All right, sounds good. So you guys are experts. You've demonstrated your knowledge tremendously. I really appreciate you taking the time to talk with me and our listeners. Kind of last call for sweeping OB3 updates, tips, tricks that you'd want our listeners to know about.
Yeah, just two, and I mentioned them at the beginning, and I was going to get to them at a certain point, and I didn't get a chance to. The first is qualified small business stocks. That's QSBS. I know some folks might have heard of it or might be aware, but essentially it's when you invest in a corporation or you own shares in a corporation that's very small, and you hold it for a period of time. You get the ability to exclude some of the gains, or maybe all of the gains, and that program has become even bigger under the new bill. So there's some rules there I don't want to get into on this, but essentially if your stock does qualify for QSBS, used to be that you had to hold it for 5 years and it was only a $10 million exclusion. Now that exclusion goes up to 15. And there's not that cliff vesting. So if you own it 3 years or 4 years or 5 years, you might still be able to get a benefit. Our firm does a lot consulting with folks on if they qualify for QSBS and how to plan for that. So if you fall into that category, we're happy to help. The other thing is, and I think this is going to be important for a lot of the advisors, is opportunity zone funds are going to be an advantage thing for clients to take advantage of. Again, not this year, but if we start looking into 2027, the ability to defer gains and have that advantage comes back. And so I suspect we were going to all start to hear over this next year or two about new funds getting spun up or new investment opportunities in opportunity zone funds. Again, as a reminder, that's when you're investing in real estate in specified areas. And if you sell something that has a large gain and you invested in that real estate, then you can defer some of that gain. It was a program that was brought out some years ago. It hasn't been advantageous for the last couple of years just because of how the time worked on that. But now it's going to come back and be something that will be in our toolkit again, starting in 2027. So 2 things to wrap up there on that.
Okay. Thank you, Chris. Jason, any parting tips or tricks, thoughts?
Oh, I mean, I think, like I say, we went over a lot today, a lot of dates. So if you heard things that, resonated with you or things that you can take advantage of, have conversations now as soon as you can. Don't wait till December. Don't wait till next year when you're going to file up taxes for the previous year, because it's probably going to be too late to do a lot of these things. So, have conversations now and do some planning. And you end up in a good place to take advantage of a lot of the things we've talked about today.
Yeah. Excellent. Well, thank you both. If our listeners would like to learn more about you and Wipfli, what's the best way for them to reach out to you?
Yeah, my email address, Lockhart at wipfli.com. So CLOCKHART at WIPFLI.com. Find me there.
Yep. Yeah. Or search us on the web, wipfli.com, and you'll find Chris and I. The private client team is right on there. Our whole group of advisors ready to help you out and answer your questions.
Awesome, guys. Well, this has been really great. Thank you again for joining us. And to our listeners, we hope you enjoyed this episode. Lots of great takeaways. So to our listeners, thank you very much for joining us. And on behalf of all of us at Midwestern Securities and Banking on Growth, thank you to Jason and Chris one more time.
This has been another insightful journey with Banking on Growth with Michael Graham and Midwestern Securities, a member of FINRA and SIPC. We appreciate your time. If you found value in today's discussion, consider subscribing for more thought-provoking discussions in the world of finance. Your support helps us continue to bring you quality insights. If you have a topic you'd like us to consider covering or have thoughts on one of our episodes, we'd love to hear it. Just email us at media@midwesternsecurities.com. Remember, the power to grow is within you. Thank you for being a part of the Midwestern Securities community. Until next time, stay inspired and keep banking on growth.